Hello and welcome to this session. I would like to run Italian France. And today we're going to talk about stock valuation. Now we have debt and we have equity. Now these are financial instruments, financial assets that companies invest in. So debt includes all borrowings incurred by a firm, including bonds, and repaid according to a fixed schedule of payments. Equity, they consist of funds provided by the firm's owners, investors, or stockholders that are repaid subject to the firm's performance. Now, let's put this into context. Simply means uh, a firm wants to raise money. They need money for investment for an asset. They can either borrow by debt, which include bonds, issuing bonds. We did that last class. If you can't remember, you have to review that session. Or equity. Equity means stock. So they issue stock to the public or to their investors, private investors, and they promise to repay these things over time. And this in turn gives them the money to do their investment. Now, there are differences between debt and equity. Just to name the characteristics, voice in management. It means that in debt, when the company issues a debt, um, the bondholder, let's call them bondholders, they don't have a voice, right? They don't have a vote. Equity, on the other hand, they have a vote. Claims of income and assets. Yes, if the company belly up, goes bankrupt, debt bondholders, they have a claim to the assets. Equity holders, they are the last set of people to be paid if anything is left back. Maturity. In debt or bond, it's stated when the bondholder buys a bond, it's stated how long the bond is issued for, 10 to 30 years. In equity, there's no stated maturity date. You hold your stock until you decide to sell it. Tax treatment. Now, interest is deducted when the company pays the bond. Interest is deducted from the gross profits, while equity, none is deducted. So that's the main difference between debt and equity. Now we're focusing on equity in this class, so let's look at preferred stock. You have preferred stock and you have common stock, right? So preferred one, these features are similar to both equity and debt in that it promises to pay a fixed stream of income each year, like a bond. Bond pay a coupon interest each year. So with the preferred stock, it pays a promised interest each year. But it does not give the bondholder the preferred stockholder any voting power. Right? Just as a bond, they don't have any voting power. It is an equity investment, however. It's shares that you buy from the company. Now, the firm makes the discretion to pay dividends. The discretion is whether they should pay the dividend this year or it should be cumulative for the years down the road. Now, preferred dividends are cumulative, yes. So if they don't pay the dividends this year, as promised, it is cumulative. So they'll decide to pay it maybe next year or next 3 years. There's no contractual obligation to pay the interest on the debts or the equity. Preferred stocks are tax deductible. So the dividends that pay the interest is deducted from tax. It ranks second after bonds in terms of priority. So when the company belly ups or goes bankrupt, after you pay off the debt holders and the bond holders, the next set of persons to pay off will be the preferred stockholders. Now let's focus on some common stock. So common stock is a form of ownership of a company and are not traded. Authorized shares. So let's discuss it. The company authorizes shares, right? So they want to raise money. Let's say they want to raise $5 million. They go and they organize with the investment banker. We'll go further into it. And they want to issue, so authorized issue shares are the shares that they have been authorized to issue for the firm, right? Even if they don't want 5, they could even issue 10 million. If it's just 5 that they want. Outstanding shares will be known as the issued shares or common stock held by investors. So let's say they have authorized 10 million and they sold or they sold 5 million, that, let's say 6 million, those are the outstanding shares. Treasury stocks are issued shares of the common stock held by the firm. Often these shares have been repurchased by the firm. So let's say that 6,000 we call outstanding shares is bought back by the firm, and say the firm bought back 3 million. The 3 million is now treasury stock. So out of the 10 authorized, I should be writing. So let's say out of the 10 million authorized, we have 6 million that was sold, so we call it outstanding. And let's say the company bought back 3 million from the 6, we call that treasury stock. So issued shares are shares of common stock that have been put into circulation. So the issued shares will be equal to outstanding shares, which will now be 3 million plus treasury stock. Let's say it's 6 million, for example. So sometimes you see on your balance sheet, this is how it would look. Golden Enterprises, equity account, common stock is 80 cents per value. Authorized, so they have authorized 35 million shares. However, issued means sold. They sold 15 of the 35. Right? Paid in capital as par is now 63. Retained earnings, and then they have treasury stock, which is 100,000 out of those 15 shares bought back. So total equity is 106 plus 4, or sorry, minus 4 gives us 102. That's how much they have as issued stock. This one we would call issued stock. Now, common stockholders, they have voting rights. Generally, each share of stocks, if you hold a stock in a company, entitles you to 1 vote. If you hold 2 stocks, it entitles you to 2 votes. Votes are, for election of directors and other special issues of the firm. Normally, it's done on an annual basis. So maybe you're a member of a credit union, right? You have a share of voting right for the board of directors and other committee members and other decisions the firm needs to make. A proxy statement is the statement transferring the votes of the stockholders to another party, right? Because most small stockholders do not attend the annual meeting to vote. They may sign a proxy statement transferring their votes to another party. Existing management generally receives the stockholders' proxies because it is able to solicit them at company's expense. A proxy battle is an attempt by a non-management group to gain control of the management of the firm by soliciting a sufficient number of proxy votes. So, it might be an inside manager wants to have their way with something. They could solicit votes from persons who just generally don't attend, so they can win the case or win the votes. Super voting shares is stocks that carries with it multiple votes per share rather than single votes per share, typically given on a regular share of common stock. And you have non-voting common stock. Now, dividends. Common stock pay dividends. We said preferred stock, they pay dividends every year. If not every year, it's accumulated for other years. Right? But at the discretion of the company's or board of directors. The company's board of directors. Now, dividends may be paid in cash or stock or merchandise. Common stockholders are not promised a dividend, but they come to expect certain payments on the basis of a historical dividend pattern of the firm. So before you're buying into a stock, it's always good to look at the historical dividend payments. Before dividends are paid to common stockholders, any past due dividends owed to preferred stockholders must be paid. As we said, preferred stockholders, they take priority over common stockholders. Now, issuing common stock, what goes on here? So initially, financing for most firms typically come from firms' original funds in the form of stock investments. Early stage debt or equity investors are likely to make an investment in the firm unless the founders also have a personal stake in the firm. So normally the founders and other members come together, put in money, right? And what we call give them shares, so they have common stock. Initially, non-founder financing usually comes from private equity investors as well. After establishing itself, a firm often goes public, meaning so they come out of their circle of investors, friends or family or other people, and they go public by issuing shares of stock to a large, broader group. And this is where you normally get it on the stock exchange. Then other issuing common stock like venture capital is a privately raised external equity capital used to fund early stage firms with attractive growth prospects. Now, this is something you can research when you have time. So, they are venture capitalists, they are providers of venture capital. You may have a firm one day, or you may be working in a company or management and need to raise money. You can go to a venture capital, right? It's a private company, and they give persons money as an exchange for common stock. But they maintain strong oversight into the firm they invest in, and they clearly define exit strategies if they need to get out. It's defined before they enter into the contract. Then there are angel capitalists or angel investors. They are wealthy individuals, so they're not company investors who do operate as a business, but they invest in promising early stage companies in exchange for a portion of the firm's equity or stock. So what it means to go public. When a firm wishes to sell its stock to the primary market, it has three alternatives. A public offering in which it offers its shares for sale to the general public, a right offering in which new shares are sold to existing shareholders, and there's a private placement in which the firm sells new securities directly to an investor or a group of investors. This happens mainly among insurance companies. You have all these private placements. They want to raise money, and the insurance company has money, right? They have persons' money, policyholders' money to invest, right? So they normally do all the things through private placements. Here we focus on the initial public offering in this class, which is the first public sale of a firm's stock. So going public means the firm decides to go public, they issuing shares for the first time. It's called IPOs, right? They're typically made by small, fast-growing companies that either require additional capital to continue expanding. Like now, small technology companies, they can go public to raise money to get investment, to get investment capacity so they can move forward, right? Get with the times. Have met a milestone for going public that was established in the contract obtained by a venture capital funding. The firm must obtain approval of current shareholders and hire an investment bank to underwrite the offering. So they don't go direct to the public, they go through an investment banker. The investment banker is responsible for promoting the stock of the firm and facilitating the sale of the company's IPO shares. Now, the company must file a registration statement with the SEC, Securities and Exchange Commission, that is, for their country. Then there's a prospectus, right? There's a portion of security registration statement that describes the key aspects and issues, the issuer and its management and the financial position. So that will include all the financial reports, a little analysis. You get the management team, the board of directors, and maybe some history A red herring now is a preliminary prospectus made available to prospective investors during the waiting period between the registration statement's filing within the SEC and its approval. Now, investment bankers and companies officials promote the company through a roadshow. Right? It's a series of presentations to potential investors around the country, and sometimes it's done for overseas investors. This helps investment bankers gauge the demand for the offering, which helps them to set the initial offer price. So they invite all these investors and show them the prospectus and hear what they are coming up with as what price they want to pay for it. So it helps the investment banker determine what's the price value of the stock. After the underwriter sets the terms, the SEC must approve the offering. So again, the investment banker, they are the financial intermediary that specializes in selling new security issues and advising firms with regard to major financial transactions. So I know I'm talking a lot, but take it into context. This is how the firm raise money through stocks. But how do they get these stocks? Do they just ask people to buy stocks? No, they have to go through the financial intermediary, who is the investment banker. In the investment bank, there's an underwriter. So in the underwriting is the role of the investment banker in bearing the risk of reselling at a profit the securities purchased for an issuing corporation at an agreed on price. So the market says a price, they add a premium onto it so that they can make money off the shares. Sometimes it seems small, but if a firm is issuing 350 million shares, you multiply that by 50 cents or by 10 cents, they make a whole lot of money. Now, this process involves purchasing the security issued from the issuing corporation at an agreed price and bearing the risk of reselling it to the public at a profit. So the investment banker gives the firm the money that they want to raise, and then the investment banker now resells this money. Now, the investment banker also provides the issuer with advice about pricing, another important aspect of issue. An underwriting syndicate is a group of other banks formed by investment bankers to share the financial risk associated with the underwriting new securities. So sometimes the shares are so large, let's say it's 35 million, right? And the investment banker and say, I don't want to take on all this risk by myself, so they form a syndicate. They go to other investment bankers and they share it. So Bank A will give 20 million, Bank B will give 5 million, Bank C will give 15 million to make up the amount, right? So they share the financial risk. The selling group is a large number of brokerage firms that join the original investment bankers. Each accept responsibility for selling a certain portion of the new security on a commission. So the compensation again for underwriting and selling services typically comes in the form of a discount on the sale price of the securities. So for example, an investment banker may pay the issuing firm $24 per share for stock, but they're selling it for 26, right? So they're making a $2. But if you multiply that $2 by 35 million, they make a whole lot of money. Now, how do we value stock? Common stock valuation. When we say valuation, we want to know what's the value or price of the stock, maybe at the present or the future value. Right? Common stock expects to be, valued through periodic cash dividends and increases in share value. So when you buy a common stock, you either get cash dividends or you get share value, appreciated value. So you buy a share for $10, you can get a dividend payout maybe every quarter of $500 or once a year, whenever the board decides to pay dividend. And you can also get a share value. So the business boom. So now your $10 share is worth $5,000. You have a share value from it. So that's how you benefit from a stock. Some of these investors decide which stock to buy and sell based on a plan to maintain a broadly diversified portfolio. Diversified means, when they tell you don't put all your eggs in one basket, means that they don't just have Amazon stock, they have Microsoft, they have Apple, and different stocks within a basket. Other investors have a more speculative motive for trading. They try to spot companies whose shares are undervalued, right? So undervalued would mean underpriced. Think about it the same way, meaning that the true value of the shares is greater than the current market price. Now, Warren Buffett, if you don't know about it, he does that. Right? Looks for those firms that their stocks seem to be undervalued. And if you buy it, the true value will eventually come so they get their price appreciation. These investors buy shares that they believe to be undervalued and then sell them. Sell that, sell them when they think they are overvalued. So we're going to go into how we're valuing these stocks. So if we're getting into this business someday, or you'll be in the management team and you hear them talking about the stock price, and you know it's at the right price, you know how to value the stock. The market efficient hypothesis. It's called EMH. It's a theory. It describes the behavior of an assumed perfect market. A perfect market in which securities are in equilibrium. Securities in many stocks. Security prices of the stock fully reflect all available information and react quick swiftly to new information. Right? So something new comes on the market, the stock price goes up to reflect that. Something bad happens on the market, the stock price goes down to reflect that. Because stocks are fully and fairly priced, investors need not waste time looking for mispriced securities. So that's the theory, that whatever price is set, it's market efficient. It's moving with the market, right? So there's no under and overpriced stock based on the EMH theory. Now we have that's the EMH theory. Now we're going into constant growth model. So we're still on common stock valuation. We're going into constant growth model. This model is a widely cited dividend valuation approach that assumes dividends again. So we're valuing or getting the price of the stock, but here we're assuming dividends will grow at a constant rate, but a rate that is less than the required return, right? Expected return. So if you get a question or you see a dividend that is constantly, they pay the same amount for maybe the next 55 years, we can use this constant growth model to figure out that price of that stock. Right? The price of the stock will be given, but we want to value it to see if it's overpriced or underpriced. It's sometimes called the Gordon growth model as well, and it's a common name for constant growth model that is widely cited in the dividend valuation. So it's basically the sum to find the price. DO will represent the dividend at year 0 times 1 plus the growth rate over 1 plus the required return plus DO, which is the dividend at year 0 times 1 plus the growth rate to the second power, which is time, so the second year, and so forth until it's infinity. So we round it off. All that formula is really telling us to find the price of the stock using the constant growth model. D1, the dividend at year 1 divided by the expected rate of return, right, minus growth. So we should do an example. So zero growth assumes no growth of dividend. No growth of dividend. So this is another one. P0 is equal to, right, when you work out all of that, it comes up to dividend D1, dividend for the year 1 divided by expected return. So this equation is used when there's no growth, zero growth, right? The value of the stock would equal the present value of perpetuity. So there's no growth in the firm's dividends. So Chuck Schumer estimates that the dividend of Denham Company as established textile producer is expected to remain constant at 3% per share indefinitely. If his required return on the stock is 15%, the stock value is now, so the dividend doesn't change, 3 divided by 15% gives us $20. So the share price should be $20. Now if the price of this share is selling at $25, we know the stock is overvalued. If it's selling at $18, we know the stock is undervalued. And so some investors will buy it because it's below the value and sell it when it goes up. Constant growth model. Right, so this one should have been before. So constant growth model now, where we said the dividend is constant, the amount paid is constant. This is the formula D1 over RS, which is expected rate of return minus growth. Here we have an example. If the market capitalization rate, sometimes known as K, or required rate of return is 12%, the growth rate is 5%, and the dividend paid in year 1 was $4. Now what is the value of the stock? Using this equation, we just plug in the figures, right? 4 divided by the required rate of return is 12% minus the growth rate of 5%, and we get 57.14. So the price of the stock, which they ask us PO, is equal to 57.14 cents. Now if the stock listed is $65, we know the stock price is overvalued. That is overvalued. If it's quoted at $50, we know that it's undervalued. So we have the zero method, we have the constant, and now we have the variable growth. Right? And all of these methods are used to determine the value of the stock or the price of the stock. Right? The variable now, there's a change in the dividend. So first we had zero growth, then we had constant growth in dividend, and now we have variable growth. Now let's take our time with this one. How do we find the price of the stock using this model? First, we find the cash dividends at the end of the year, DT. Right? How do we do that? D0, the dividend on year 0, the first year, the end of year 0, times 1 plus the growth rate for the first year over T, right, which is the first year. Secondly, we find the present value of the dividends expected during the initial growth period. Right, and then we find the value of the stock at the end of the initial period. So let's do an example. Right, so we go to step 4, where we really find the present value of the dividends during the growth period. Now, but it's variable, so we need to find the present value of the sum of them, all the years. And then we add it to the present value of the price of the stock at the end of the initial growth period to determine the price of the stock. So the example says Victoria Rubb is considering purchasing the common stock of Warren Industries, a rapid growing boot manufacturer. She finds that the firm most recent 2015 annual dividend payment was $150 per share. Victoria estimates that these dividends will increase by 10% annual rates. Right? This is a growth rate over the next 3 years, 16, 17, and 18, because of the introduction of the new boot. At the end of 3 years, which is 2018, she expects the firm's mature product line to result in a slowing of the dividend growth rate to 5%. So not 10 again, 5 per year. That's G2 for the foreseeable future. Victoria's required rate of return is 15% to estimate the current 2015 value of warrant stock. P0 equals P 2015. And so she applies the four-step approach. Let's see how we do this. So the value of the cash dividend in each of the next 3 years is calculated in column 1. So step 1. Step 1. We have D0, right? So D0 is 150. Step 2, we take 1 plus the growth rate for that year over time, which is the first year. So the rate is 10%. 10%, right? So it's 1. So let's do it here. So let's do this again. So step 1 for 2013, 2014, 2015, we have the dividend. Yes, 0 is 150, right? $115. For step 2, we have, let's go back. Step 2, we're going to find this part, the present value of the dividend. No, we're still on that. The 1 times 1 plus 2. So we go here. You see, we have 1 plus 0.10. Right, that's here 1. So we're going to put 110. Here 2, 1 plus 0.10 squared, 1.210. Here 3 of 2015, 1 plus 0.10 to the third power, we have 1.331. Now when we're through that stage, right, so this is this stage, we need to take our dividend, which is DO, and multiply it by 1 plus the growth rate, right? So we multiply in each of them, 110, and this is where we get 1.65, 1.82, and 2.00, right? So they now become the dividend for the next 3 years. Alright, so we're finding the present value as we go forward now. Alright, so we have this column, fourth step, fourth phase or fourth column. One plus the required rate of return by T. So we have 1 plus the required rate of return is 15%. We have it here, 15%. T is for the 1 for the first year, 1 plus 15%. Second year, 1 plus 15%. Third year, this is how we get 1.150, 1.323, 1.521. Present value of the dividends now. We divide 1.65 by 1.4, and we get the present value of the dividends to be 1.43. Now 182 divided by 1.323, we get 1.37, and 2 divided by that, we get 1.32. Now you see the formula has to sum it, so we need to sum it. Right, summing the present values of the 3 years, we get 4.12. Now we're not finished yet. It says now the value of the stock at the end of the initial period 2018 can be found by first calculating for 2019. So the value of the dividend 2019 is 2018, the 2018 dividend times 1 plus the growth rate, which is equal to $2. Alright, remember we calculated it here. $2 times 1.05 growth rate equals to $2.10. So we have 2019, $2.10 at 15% required return and 5% growth model. The value of the stock, the price of the stock for 2018 now, we're using the equation for variable growth. 2019 to 10, the year before, divided by required rate of return minus growth rate, $21 is the price of the stock for 2018. Finally, in step 3, the share value of 21 at the end of 2018 must be converted to its present value of 2015. Right? Using the 15% required rate of return, we get 2018 over 1 plus the required rate of return 3-year period. We get 1381. Adding the present value of the initial dividend stream found in step 2 to the present value of the stock at the end of the initial growth period found in step 3, as specified in equation 7.5, the current end of 2015 value of warrant stock is now $4.12, right? Because we find the present value of those 3 years plus present value from year 15, 2018. The price of the stock for 2015 is $17.93. So she's considering buying the stock. Victoria's calculation indicates that the stock is currently worth $17.93. Now they didn't tell us in the problem how much it was selling for. So let's assume it's selling for $32. What would you say? Should she buy it? No, she may not want to buy it because it is undervalued. It is overvalued because she has valued it as $17 but it's selling as $32. She wouldn't want to buy it. She won't buy it. Now, there's another method we use to value the stock called the free cash flow method. Now, this is the formula. It represents the same thing as the dividend growth, not dividend growth model, the dividend variable model. And you can see VC represents the value of the entire company, and FCF will represent the free cash flow expected at the end of the year. Now, and RA is the weighted average cost of capital. Note the similarity between equation, well, the same equation. So when you sum all that up, it should be equal to the value of the stock is equal to the value of the company minus the value of the dividend minus the value of the preferred shares or preferred shares, common stock minus the dividend minus preferred shares. Sorry, that's what it is. So let's look at an example. This is the table, an underwriter, not an underwriter, CFO, forecasted for a project, asset, alright, and they estimated that this asset will bring in 2016 400,000, 2017 450, and so forth. Other data, the growth rate for the future cash flow, free cash flow beyond 2020 is infinity, is 3%. Right, from 2020 it continues to grow at 3%. Weighted average cost of capital is 9%. Market value of the debt, right, there's a debt involved, 3.1 million. Market value of the preferred stock, 800. And number of shares of common stock, 300. So we have that information. Step 1 is to calculate the present value of the free cash flow occurring from the end of 2021 to infinity. Alright, so what is that cash flow at 2021? Because a constant growth model in free cash flow is forecasted beyond 2020, we can use the constant growth dividend valuation model to calculate the value of the free cash flow for the end of 2021. So it's the same thing where we had D1 over expected rate of return minus growth rate. So here we have the free cash flow for 2021, 600,000. Right, so D0, that's the last year, times 1 plus the growth rate divided by expected rate, 9% minus growth rate, 3%. So we are 9%, 3%. So the value, present value of the free cash flow for 2021 till infinity is 10,300. Note that to calculate the FCF in 2021, we had to increase 2021 value by 3%, right? Step 2, add the present value of the future cash flow from 2021 to infinity, which is measured at the end of 2020, to get the value. So we have to add 2020, but we got 10,300. We have to add the 600 from 2020 to 2021 plus 2020. The free cash flow for 2020 now is 10,900. Then we find the sum of the present values of future cash flow for 2016 as we start through 2020 to determine the entire company's value, right? The calculation is shown here. So we list all the free cash flow, and then we list the 1 plus the required rate of return by time. So these figures here is required rate of return, we're told is, weighted average cost of capital. So this here is 1 plus 0.09. 1 plus 0.09 squared. 1 plus 0.09 to the third power. And when we're done, we multiply them to get these figures. And we sum it, we get 8,626,426. Right, so the last step here now, to calculate the value of the firm. Remember, we had the equation here. The value of the company. We need to take away the debts, common stock and preferred stock, right? So we have the market value, we have preferred stock 800, Debt 3.1 million. And we just found the value of the common stock, right? So the total value of the firm is 4,726,426. The value of the whose common stock is therefore estimated to be 4,726 by dividing this total by the 300 shares, 300 shares outstanding. We get the price of the stock. Price of the stock should be $15.75. Again, it's used to measure. If you see the stock price, you know if it's accurate. Now there are other methods in which we can calculate the price of the stock or value the price of the stock. So briefly, we have the book value. The book value per share is simply the amount per share of common stock that would be received if all the firm's assets were sold for their exact book accounting value, and the proceeds remaining after bills or liabilities, including preferred stocks, were divided among the common stockholders. Now, this method lacks sophistication and can be criticized on the basis of its reliance on historical balance sheet data. It ignores the firm's expected earning potential and generally lacks any true relationship to the firm's value in the marketplace. So let's look at an example. At the end of year 2015, Lama Company balance sheet shows total assets of $6 million, total liabilities and preferred stocks of $4.5 million, and 100 shares of common stock. So here we have 600 minus all the debts and preferred stock divided by the number of stocks, $15 per share. That's how we find the price of the share under the book value. Right? You take the assets and you minus the liabilities and divide by the number of shares. Liquidation value per share, this is another method, is the actual amount per share of common stock that would be received if all the firm assets were sold for their market price. Liabilities and preferred stocks were paid, and any remaining money was dividend among the shareholders. So Lama Company found an investigation that could obtain only $5.25 million if it sold its assets today. Found upon investigation that it could only obtain $5.25 million if it sold its assets today. The firm's liquidation value per share would therefore be 5.25 minus all the debts divided by the number of shares outstanding, giving you 7.5%. And the final one, you hear about the PE ratio. It's the price earning ratio. It reflects the amount investors are willing to pay for each dollar of earning. So the PE ratio is a popular technique used to estimate the firm's share value. If you listen to stock news, you'd hear a lot about PE ratio. It's calculated by multiplying the firm's expected earnings per share, EPS, as the annually profit and loss statement, you find that, by the average price of PE for the industry. Now you can get the PE ratio in the Standards and Poor's statement. So Lama Company is expected to earn 2.6 per share next year as the expected returns. Assuming the industry average is 7, the firm per share value would be 260 times 7, $18 per share. So that's another way. And that's the end of our lecture. See you in the next session.